What if I told you that a single piece of paper in your wallet helps determine the price of gasoline, groceries, smartphones, and even the strength of the world's economy? And what if that paper suddenly lost its power? For decades, the US dollar has been the king of global currencies. Countries trade with it, governments store it, investors trust it, and businesses around the world depend on it. But recently, a growing number of nations have begun asking a question that would have sounded impossible just a few years ago. What if the world no longer needs the dollar? Could America lose its financial superpower status? Would prices explode? Could the economy crash? Or is this fear being exaggerated? Today, we're diving deep into one of the biggest economic questions of our time. What happens if the US dollar loses power? And by the end of this video, you'll understand why economists, investors, and world leaders are paying very close attention. To understand what could happen, we first need to understand why the dollar became so powerful in the first place. After World War II, the United States emerged as the strongest economy on Earth. Much of Europe was rebuilding. Asia was recovering. America, meanwhile, had enormous industrial capacity and economic strength. As global trade expanded, countries needed a reliable currency to conduct business. The US dollar became that currency. Over time, it transformed into what economists call the world's reserve currency. What does that mean? It means central banks across the globe hold massive amounts of dollars as financial reserves. When countries buy oil, trade goods, pay debts, or protect their economies during crises, they often use dollars. Today, trillions of dollars are held by governments, banks, corporations, and investors worldwide. This creates enormous demand for the US dollar. And that demand gives America unique advantages. The United States can borrow money more cheaply. Its financial markets attract global investment. And its government enjoys a level of economic influence that few nations have ever possessed. In simple terms, the dollar isn't just America's currency. It's the world's currency. But in recent years, cracks have started to appear. Countries such as China, Russia, India, Brazil, and others have begun discussing ways to reduce their dependence on the dollar.
Why?
There are several reasons. First, geopolitical tensions have increased. Many countries worry about relying too heavily on a currency controlled by another nation. Second, technology is changing finance. Digital payment systems and central bank digital currencies are creating new possibilities. Third, emerging economies want greater influence over global trade. Some leaders believe the current financial system gives the United States too much power. As a result, more countries are experimenting with trade agreements that bypass the dollar. Some buy oil using local currencies. Others establish direct currency exchange arrangements. These developments have fueled discussions about de-dollarization. That's the process of reducing the role of the dollar in international trade and finance. Now, does this mean the dollar is about to collapse? Not necessarily, but it does raise important questions about the future. Let's imagine a hypothetical scenario. Suppose the dollar gradually loses its position as the world's dominant reserve currency. What happens next? The first impact would likely be reduced global demand for dollars. Remember, part of the dollar's strength comes from the fact that governments and institutions around the world constantly need it. If fewer countries need dollars, demand falls. And when demand falls, value can decline. A weaker dollar means imports become more expensive. Think about everyday products, electronics,
Clothing.
vehicles, raw materials. Many items Americans buy are produced overseas. If the dollar weakens significantly, purchasing those goods becomes more expensive. That means consumers could face higher prices. And businesses that rely on imported materials could see rising costs. Those costs often get passed on to customers. Which brings us to the next consequence. Inflation. Inflation occurs when prices rise across the economy. If the dollar loses purchasing power, imported goods become more expensive. Energy costs could increase. Manufacturing costs could rise. Food prices might climb. The average American family would feel the impact almost immediately. Imagine going to the grocery store and discovering that many everyday products cost noticeably more than they did a year earlier, or paying significantly higher prices for gasoline. or replacing a smartphone, and finding the cost has jumped dramatically. Inflation acts like a hidden tax. It reduces the purchasing power of money. Even if your salary remains the same, your money buys less. That's why economists closely monitor inflation. And that's why a weaker dollar can create serious challenges. Another major concern involves government debt. The United States has accumulated trillions of dollars in national debt. One reason America has been able to borrow so much is because investors around the world view U.S. government bonds as safe assets. But what happens if confidence weakens? Investors may demand higher interest rates.
Why?
Because they perceive greater risk. Higher interest rates mean the government spends more money servicing debt. That leaves less money available for infrastructure, education, healthcare, and other priorities. And the effects don't stop there. When interest rates rise, borrowing becomes more expensive for everyone. Businesses, home buyers, students, credit card users. The entire economy can feel the pressure. Let's talk about Wall Street. Financial markets thrive on confidence. When investors trust the future, they invest. When uncertainty increases, volatility often follows. If the dollar's dominance were seriously challenged, markets could experience significant turbulence. Investors might move money into alternative assets, gold, foreign currencies, real estate, commodities, or emerging markets. Some companies could suffer. Others might benefit. Export-focused businesses might become more competitive because a weaker dollar makes American products cheaper overseas. But firms dependent on imports could struggle. The result could be increased market volatility and uncertainty. There's another consequence that often receives less attention: geopolitical influence. The dollar isn't just an economic tool. It's also a strategic asset. Because global trade relies heavily on dollars, the United States has significant influence over international finance. Sanctions, banking systems, global transactions. Many of these mechanisms depend on the dollar's central role. If that role weakens substantially, America's ability to influence global economic behavior could decline. Other nations could gain greater financial independence. New alliances could emerge. And the balance of economic power might gradually shift. This wouldn't happen overnight. But over decades, the effects could be profound. This is where things get interesting. If the dollar lost power, what would replace it? Many people assume the answer is China. Specifically, China's currency, the yuan. But the reality is more complicated. To become a dominant reserve currency, a nation needs more than a large economy. It needs transparent financial markets, strong institutions, political stability, investor confidence, and global trust. These qualities take decades to build. Currently, no single currency appears ready to completely replace the dollar. Instead, the future could involve a more diversified system: the euro, the yuan, regional currencies, digital currencies, and perhaps even new financial technologies. Rather than one dominant currency, the world could move toward multiple centers of financial power. Now, let's explore another possibility: digital currencies. Over the last decade, cryptocurrencies have attracted enormous attention.
Bitcoin,
Ethereum, and thousands of others. Some supporters believe digital assets could eventually challenge traditional currencies. Others disagree. Meanwhile, governments around the world are developing central bank digital currencies, often called CBDCs. These are digital versions of national currencies. Some experts believe digital finance could transform international payments. Transactions could become faster,
cheaper,
and more efficient. If these technologies continue advancing, they could reshape how money moves around the world. Whether they replace the dollar is another question entirely. But their rise is something policymakers cannot ignore. Let's bring this closer to home. What would dollar weakness mean for everyday Americans? The answer depends on the severity of the change. In a moderate scenario, prices rise gradually. Imported goods become more expensive. Interest rates increase somewhat. Economic growth slows. Most people adapt. Life continues. In a severe scenario, inflation accelerates. Borrowing costs surge. Financial markets become unstable. Economic uncertainty grows. Consumers reduce spending. Businesses cut investment. The economy experiences significant stress. Fortunately, most economists believe an abrupt collapse remains unlikely. The dollar still possesses enormous advantages: large financial markets, global trust, institutional strength, and deep integration into world trade. Despite all the headlines about de-dollarization, it's important to understand something. The dollar remains extraordinarily powerful. In times of crisis, investors still tend to buy dollar-denominated assets. Why? Because they trust them. A trust is one of the most valuable assets in finance. And trust cannot be created overnight. It develops over decades. The United States continues to have some of the largest and most liquid financial markets in the world. Its economy remains among the most innovative. Its institutions remain highly influential. These factors provide powerful support for the dollar. That's why many economists argue that while the dollar's share of global finance could decline gradually, losing dominance entirely would be a long and complex process. So, what is the most realistic outcome? Probably not total dollar collapse. And probably not permanent dollar supremacy either. Instead, the future may look like a gradual shift. The dollar remains the leading currency, but alternative systems gain importance. Countries diversify reserves. Regional trade expands. Digital technologies grow. Financial power becomes more distributed. This transition could take years or even decades. History shows that major economic transformations rarely happen overnight. They unfold gradually, often in ways that are difficult to predict. The US dollar has been the foundation of the global financial system for generations. Its dominance has provided America with enormous economic and geopolitical advantages. But the world is changing. New powers are emerging. Technology is evolving. And some countries are searching for alternatives. If the dollar loses power, Americans could face higher prices, increased borrowing costs, slower economic growth, and reduced global influence. Yet the dollar's position remains remarkably strong. No clear replacement currently exists. And trust in the U.S. financial system continues to support its global role. The real question isn't whether change is possible. The question is how much change will occur and how quickly. Because the future of the dollar isn't just about money. It's about the future balance of power in the global economy. And that future is being written right now.